Dealing with the aftermath of the tragic shootings in Texas, of breaking the COVID restrictions, and of stimulating the economy too much. This is Bloomberg Wall Street Week. I'm David Weston. This week, our special contributor Larry Summers of Harvard on just how bad inflation has gotten to be.
Fed's forecast from March saying that inflation would be coming down to the twos by the end of the year was frankly delusional.
And senior markets editor John Authers on the downturn in ESG investing and whether there is more yet to come.
Until now, you've been able to have your cake and eat it.
It was another week of dealing with the unimaginable killing of 19 elementary school children in Texas, with the Uvalde native son Matthew McConaughey at the White House calling for gun legislation.
I'm here today in the hopes of applying what energy, reason, and passion that I have into trying to turn this moment into a reality.
And Congress taking up the question.
The U.S. House has passed a package of gun legislation, a mostly symbolic action.
I don't know what will come out of the negotiations in the Senate, but I have confidence in those who are negotiating in good faith on both sides of the aisle, and we're eager to see what that will be.
At the same time Congress was dealing with guns, it was also looking into what led to the insurrection at the Capitol in January 6th of last year.
You will hear that President Trump was yelling and, quote, really angry at advisors who told him he needed to be doing something more.
January 6th was the culmination of an attempted coup.
And in the United Kingdom, Prime Minister Boris Johnson faced something of an insurrection himself, as members of his own party called for a no-confidence vote, which he won, but not by much.
You're in a worse position than Theresa May was after her vote in 2018. And you think this is a good result?
I think it's an extremely good, positive, conclusive, decisive result.
When we weren't dealing with insurrection and the killing of innocent children, we had the economy to reckon with, as Treasury Secretary Yellen told Congress that high inflation will continue, but that getting it down is her job one.
I think that bringing inflation down should be our number one priority, and President Biden has indicated that it is our top priority.
And boy, was she right. At the end of the week, the consumer price numbers came in showing just how hot inflation is, with the headline number up 8.6% year over year, and the core, excluding food and energy, up 6%, which sent the markets down the most in 3 weeks, with the S&P 500 off 2.9% on Friday alone, for a total loss of 5% for the week overall, making it 9 out of the last 10 weeks the market's down. And tech was hit even harder, as the Nasdaq lost 5.6% over the course of the week. Treasuries fared no better, leaving the 10-year yield well above 3%, 3.155 to be precise, and even the 2-year was over 3% at the end of the week. To take us through this rocky week, we welcome now Sonal Desai. She's Chief Financial Officer of Fixed Income at Franklin Templeton. And Savita Subramanian, she is Head of U.S. Equity and Quantitative Strategy at Bank of America. So welcome to both of you. Great to have you here supporting me during this very difficult week. So let me start with you, if I could, Savita. What do you make of what the markets did this week? I mean, inflation looks like it's here to stay. It appears right now.
It does. And I think the markets actually were fairly well behaved against a backdrop of rising interest rates, rising nominal yields. I think, this is a year where the discount rate for equities has demonstrably increased, and we've seen that play through to stocks. The risk of equities right now, and especially the S&P 500 and the Nasdaq, are that these are very long duration benchmarks. There's a lot of growth promised way out in the future for these benchmarks, and we think that that's going to be a continued challenge if we see those discount rates rise, as we've seen so far this year.
So now when we talk about challenges, I should say fixed income has a few challenges of its own. It looks like the Fed is going to have to be rate hiking for some time to come. What do you make of what's going on in the bond market?
So, I'd just say that we have gone up almost 40 basis points in about 10 days on U.S. 10-years. This is the deepest, most liquid market in the world. And I'm just looking at this, and this level of volatility, it can't be anything that any central bank would welcome. I do think that, unfortunately, we are going to see more of the same, and it's not going to be a nice, smooth grind upwards. We're going to see volatility, but inevitably, the Fed is actually going to need to do more. I think that in the last, after the last Fed meeting, what Fed Chair Powell delivered was a dovish hike. I think what we're going to need to see next week is a hawkish hike. So a promise to follow that the Fed is going to do everything it needs to do without it being limited to a couple of more months of 50 basis point hikes, for example.
So, Sonal, I'm not going to ask you to guess at what the Fed will do next week and going forward, but if you were advising the Fed, would you say it's a matter of when you raise rates or how much you raise them? That is to say, is this a matter of let's get there faster, but the ultimate number we're getting to is not that much higher? Or do these numbers suggest actually you're going to end up higher, Sonal?
I think you might need to get higher. That's the reality. Because, you know, I did see something which has baffled me about the Fed dot plots from March, and that's actually almost as interesting as the actual meeting next week, is that the Fed essentially had inflation coming down almost by itself. There was in the sense that you had massively negative rates, even as inflation was collapsing in those dot plots. I don't think that's realistic, not in the least. Therefore, I will be looking for some added layer of sober realism in what the Fed shows us next week. And to your question, is it how much or is it when? I think it's actually both. It's probably going to need to be higher rates, and we need to get there faster. It's smarter to get there faster because, let's put it this way, we've had a full year of inflation being above 7%. We've had 2 years of inflation being actually above 6%. Right. So when do expectations start catching up with this?
You know, I think that that's a great point. And, you know, one of the things that we're seeing is that the multiple on the market is still really out of whack with where inflation is right now. Yeah. So when you think about the relationship between the PE ratio of the S&P and inflation rates, usually when inflation rises, PE ratios come down. Granted, we've seen the multiple come down with the sell-off in the market, but we're still at a fairly high and elevated level of valuation for where we are on an inflationary basis. So I think, you know, when we look at the data, there are some pockets that suggest we're seeing an alleviation in the pricing pressure. So, for example, we look at our credit card data at Bank of America, and we found that the shift in spending has moved from big ticket items to services. So, at some level, one could argue that may serve as some, moderation in the inflation of raw materials that are used for goods like metals, lumber, cotton, et cetera. But I think the demand for energy and for oil from flying and hotels and all of the activities that we have pent up demand for is going through the roof, and energy is going to continue to be a point of pain for investors and consumers.
So now what about it? Are we seeing some peak inflation in some pockets?
So, you know, I do agree with Savita to some point, to some extent. I'd say that, yeah, we also see pockets where we've probably peaked, but I think we're also seeing a little bit of broadening out, actually, because to some extent, we are seeing the impact of the fact that people still have reserves from two different sources. One is the savings, which came in the post-COVID period. They have banked a certain amount of savings. Those savings will get used, no doubt, quicker now than we would have anticipated at the end of last year, prior to the energy shock. But we still think that we've probably got enough by way of savings to take us through probably the better part of the first quarter of next year. But even above that, even above the issue of just savings, people are actually going out and using those savings, and consumers are entering this phase of the cycle with some of the healthiest balance sheets that we have seen consumers have. They are in a position to actually rack up credit card debt. And historically, the US consumer has done that. It might be a first in the post-GFC period, but I wouldn't be surprised if we started seeing that debt rack up.
So now, is anything going to stop this runaway inflation short of a recession?
so one thing I would note, I don't think it's runaway inflation. So I should just note that I think that it's more like pretty high inflation and way too high to be comfortable for the Fed. And I don't know whether you're going to get an outright recession, but I think you are going to need a significant cooling off of the labor market. And the problem is timing. I don't think it's going to cool off quickly enough to prevent us from having quite a lot of inflation first.
So, Sonal, I'm just curious your views because, I remember before the pandemic, we were all talking about disruption and demographics and all these sources of disinflationary pressure that were long-term secular forces. Some of those are still in play. So, I think that there could be some kind of natural suppressants, as you say, maybe this isn't runaway inflation because we still have some, kind of ceilings or pressures on inflationary forces from just those themes that have been in place for the last decade or so. What do you think?
So actually, we've always talked about demographics as always playing in one direction. And I think that's off the back of Japan. And every case is a special case, right?
Yeah.
But if I look at China, there's been some very decent academic work which actually has said that demographics are going to play in the opposite direction in the case of China.
Sure.
Separately, I would say that there are new trends which have come out almost as a result of COVID, one of which is insourcing or local sourcing.
Yeah, absolutely.
And we've got to remember, the reason people outsourced in the first place was to reduce costs. You bring that back closer to shore, it's going to raise costs. And we haven't even started talking about issues like greenflation, which I think is a real thing.
No,
almost
I think
separate from. And so I think there are new secular forces, Savita, which actually add to those original ones. So I am uncomfortable today with the entire idea that we have some kind of a long-term destiny towards low rates and deflation. I just don't think it's there.
When we come back, we're going to have much more with Sonal Desai and Savita Subramanian. This is Wall Street Week on Bloomberg.
The stock market, as is its wont, sniffed and got nervous. But just when it seemed that it had finally found the excuse to begin its long-awaited downward correction, after its mightiest rally in years, the market was confounded by more portents of better news ahead. Interest rates definitely seem to be heading down again. New York's First National City Bank, the industry leader in this department, moved its prime interest rate, the one it charges the big corporations, down to 7%, the lowest in more than 2 years.
That was Louis Rukeyser on Wall Street Week way back in 1975 when the world seemed so much simpler. The U.S. economy was coming out of a recession at that point. Inflation was coming down from the stratospheric numbers of 17% to the much tamer area of 4%. And, oh yes, the predecessor of Citi was called National City Bank back then. Still with us are Sonal Desai of Franklin Templeton and Savita Subramanian of Bank of America. Sonal, let me start with you here on fixed income. I guess my question is, if in fact inflation is here to stay, at least as far as we can see, how does that change an investor's decision? For example, with fixed income, what does that make you attracted to?
So right now, I'd say what it makes me attracted to is staying short duration, right? You stay short duration, you are extremely careful. As much as Savita said, you look at individual sectors in the corporate debt space, and you are very careful about selecting individual corporates if that's where you're going in the event that we have a period before a distinct slowdown in the economy. You can look at things like floating rate. But to me, what I think about as, the light at the end of the tunnel is actually that if we get through the next year, the next year and a half of rates going up and fixed income looking rather unattractive at the long end, we do come out at the other side where it finally, after maybe close to 14, 15 years, we will have what I would think about as a bog standard recession, i.e., you would have long end rates high enough and short end rates high enough that the Fed could actually stimulate the economy using that old-fashioned tool of cutting interest rates. And that actually is a positive environment for fixed income. It's just that we've got to get from point A to point B. And during that time, especially right now, we're going to see a lot of volatility.
Same question on equities.
So on equities, I think it's a similar answer, but it's the idea of short duration or medium duration equities, and this would be dividend yield, dividend growth, companies that are giving you your cash up front. And one of the things that we've noticed is that dividends lagged earnings growth last year. We saw a lot of earnings growth, 50% earnings growth last year, but dividend growth was, just a fraction of that. I think we're going to see catch up. I also think we're moving into a total return world. And if you think about it, since the beginning of the S&P 500, over a third of your total return has come from income. In the last 10 years, we've had this heyday for stocks and price returns, but I think we're moving back to an environment where total return and dividends are going to be a much bigger part of our overall wealth creation.
Savita, at Bloomberg, we tend to talk about sectors a lot when it comes to equities. I saw that you said not so much sectors as it is factors.
Well, so it's interesting because, everybody wants to know what consumer stocks are going to do during a rising rate environment. And if you think about the consumer sector today versus 20 years ago, two of the biggest stocks in consumer discretionary are Amazon and Tesla. 20 years ago, it was Walmart and GM. These are different types of companies that are going to behave differently in an environment of rising rates. So the way we like to slice and dice the market is by looking at factors. And what I mean are, kind of themes or ways to pick stocks like free cash flow yield is one of my favorite screening criteria. Because I think, as Sonal mentioned, we're in an environment where the Fed is basically moving cash yields from 0 to 3 or 4 in a very short period of time. So free cash flow yield at an equity level, I think, is one of the most powerful ways to invest today.
So now on fixed income, at what point do we need to be concerned about credit risk? I mean, what about default? Remember the old idea of default?
Yeah.
We haven't had much of that lately.
Yes. No, we haven't had much of that lately. And I think that already the issue of choosing with care is becoming increasingly important literally by the week and month. Having said that, a lot of corporates are coming into this period in much better shape than they were previously. And I think, again, it's singing from the prayer book, but you've got to be active. You've got to make sure that you're picking very carefully. I think going back to what Savita said, fixed income at the end of, the silver lining that I was talking about is that, in fact, there will be some income coming from fixed income, something which we haven't had now for a good 15 years. So I think that's another thing which is a positive over the medium term. But or not right now, but we will get there.
The path to getting to that point, though, could be much more painful for bonds than for stocks. So I think the benefit of stocks is that earnings grow with inflation rather than just a fixed coupon. And I think that's where we see the opportunities within the equity market.
I would just note, though, there are also questions about starting valuations. I'd be the last person to argue that bonds were particularly undervalued coming into this particular period. But I think there could be some debate as to where we were starting. But definitely, it's not a time to be long duration, which does tend to move you towards equities, particularly since the slowdown, I don't see that happening in the next quarter or 2 quarters in a meaningful way. So I think it's further out. It's a part of the reason that inflation will stay relatively strong, I believe, as we go forward in the next few quarters. The economy is not going to have slowed down quickly enough.
Savita, Sonal said a lot of corporates go into this from a credit point of view in a strong position.
Yeah.
A lot, not all.
Not all.
And it makes me wonder about the so-called zombie corporations. There are more of them out there than we think there are.
Absolutely.
And I think this is when we talk about bathing trunks and the tide going out and things like that.
Right. No, I think that we've been in an environment where hurdle rates were effectively zero, capital was free, and it funded almost any company that needed capital. And today we're starting to see the real companies, the wheat separated from the chaff. And I think that's a good thing. I mean, we're getting back to a more rational market environment. We've come back to a point where real rates are positive where they were negative last year. So I think there are a lot of positive trends that we're seeing that will create more of a stock pickers market, more of a market where active managers can actually outperform the passive benchmark, which is something we haven't seen in quite a while. I think we're past the point where all you need to do is buy an S&P index fund and you'll be fine.
So now I'm curious, besides factors and sectors, you also have geography. When it comes to fixed income, are there some opportunities if you go geographic?
So I think there probably are, because the reality is I look at the US and I look at Europe. Europe is facing what I would consider a more traditional supply shock.
Right.
The price of gas has gone up 3 times. It's 3 times more in Europe than it has in the US because of our different situations.
Right.
In the US, instead, I think you're going to see divergent monetary policies, which is something which we haven't really seen again in a long time. And that always offers up some opportunities in fixed income.
Okay, it's fascinating. This has been a terrific discussion. Thank you very much, both of you. That's Sonal Desai and Savita Subramanian talking about what happens if inflation is here to stay. Coming up on Wall Street Week, we're going to go across the country to the Port of Los Angeles, where difficult labor negotiators could pose a further danger for the supply chain. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Well, inflation is very much in the news this week with those CPI numbers. And when we talk about inflation, we have to talk about the supply chain. There have been a lot of problems in the supply chain, but there may be another one developing with some labor relations problems out in the Port of Los Angeles. And our colleague Ed Ludlow is in the Port of Los Angeles to report on just that.
David, the Port of Los Angeles experienced another record quarter in May in terms of the number of containers passing through. The bottlenecks that we saw, which included empty containers sitting idle, are improving, but there's still concern that in the background you have negotiations between the Longshoremen and Warehouse Workers Union and the PMA, the operators of the ports here on the West Coast. The concern as it relates to inflation is that if those contract talks do not proceed and there is a stalemate or an impasse between the two sides, it could disrupt the work that's going on behind me. We could see more backlogs, a lack of availability of containers to move goods. And what does that mean? Likely higher container rates, which could add to the inflation that we've seen in recent months. There's another concern, which is that container rates are already too high. In his address, President Biden said to the shipping companies that it is not acceptable, although it's worth noting that shipping container rates have come down from their peak in September as those supply chain bottlenecks have started to unravel. He called on Secretary Walsh, Labour Secretary Walsh, and also Transport Secretary Buttigieg to continue to work with the different parties, the different tentacles of the supply chain to improve things. If there's one area that is still a bottleneck, it is on the rail. If you look behind me, the containers are being offloaded from those ships. They often find their way onto a truck, and that truck carries them away to their final destination. But many are taken from the ships straight to the rail lines. That is an industry that did not invest during the pandemic, that furloughed a number of employees. Now it is a bottleneck where there are not enough rail cars, and all sides are telling me that they want to see improvement in that area if supply chains are also to improve. There was some praise for the administration from port executives that I spoke to. They thanked the White House for promising to get their checkbook out, because there needs to be long-term improvement in infrastructure if we are to avoid these kinds of supply chain crunches in the future. Back to you, David.
Many thanks to Bloomberg's Ed Ludlow reporting from the Port of Los Angeles. Coming up, what goes up usually goes down, and ESG investing is no exception. We talk with Bloomberg's John Authers about the past and the future of investing based on the environment, social, and governance. This is Wall Street Week on Bloomberg. Environmental, social, and governance, ESG investing, has become all the rage, with everyone extolling its virtues, from investors
ESG investing has gone from niche to mainstream
to bank CEOs.
Perhaps in the old days, there was a bit of a trade-off between ESG and returns. Now, I really think they go hand in hand.
But some of that enthusiasm may be waning a bit, as one prominent HSBC executive charged with ESG investing questioned whether it really makes sense.
Stuart Kirk is the head of responsible investing for the bank's asset management unit. He criticised HSBC for paying too much attention to climate and other environmental and social issues.
While the head of Deutsche Bank's asset manager lost his job after police raided its offices, apparently looking for ESG fraud.
Vermon's resignation comes just hours after Frankfurt police raided the headquarters of Deutsche Bank and DWS. Prosecutors say the search was related to allegations that DWS was inflating its ESG credentials.
In the wake of all this, Larry Fink of BlackRock, a strong supporter of ESG investing, made it clear he thinks the government has to step up to police it all.
I don't want to be the environmental police. I think it's wrong to ask the private sector to tell the entire society we have to move forward.
While former Treasury Secretary Larry Summers questions the very premise of getting better returns by going the ESG route.
I think the problem comes when people who really have an environmental motivation try to attach an economic motivation and make economic arguments that aren't really very strong.
And to take us through the ups and the downs of ESG investing, we welcome now John Authers. He is the senior editor for markets here at Bloomberg. John, thank you so much for being on Wall Street Week.
Oh, it's a pleasure.
So let's talk about the downs for a moment.
Yes.
There was a robust growth in ESG investing, however one defines that, for quite a time. Now this year we're seeing it trail off. Why is that?
I think there are a number of factors in there. One big part of it is simply that until now you've been able to have your cake and eat it, because ESG investing has actually generally outperformed non-ESG investing. That's because the oil price has been low and there's been great excitement in putting money into clean energy stocks. Once you have an oil price rocketing higher, you begin to have to make some more painful decisions about whether you're really prepared to forsake money to do ESG. So that's one major part of it. Then there is a broader sense of a reckoning with the attempt to make capitalism kinder. We had a decade or so of people blaming the Milton Friedman idea of shareholder value, that the only legitimate purpose for company managers was to maximize shareholder returns, and that's seen as part of how we've had this very sluggish and hollowed out economy while the stock market has risen. Now that ESG has got as big as it has, people are beginning to ask, is this working either? Is this actually slanting playing fields in ways we don't want?
Well, another question besides is it working is what it is. Because different people define it very differently. I mean, now I see people think it's just responsible investing.
Yes, I mean, it's developed over the years. Like 30 odd years ago, it was ethical investing, and it was generally, particularly religious groups, excluding things they really didn't like, most obviously alcohol, and even 30 years ago, carbon fuels. Then it moved on to being SRI, socially responsible investing, which made more of an attempt to positively find, quote unquote, good companies to invest in. And ESG is much more of an attempt to industrialize the whole process.
But is it a way to make more money, or a way to do more good, or do a little of both? And in doing that, do you do neither?
Well, I think Milton Friedman probably might accept ESG funds because it has made a lot of money so far for the people offering the funds. There is research, although it's interesting that it's always the same few pieces of research that get cited, that shows that investing in companies that show up well on ESG indexes does actually pay. And there would be good reason for that if you're socially responsible, if you have good governance, if you're ahead of the curve on the energy transition, you probably will do a bit better in the long run. So there are ways in which it has made money over time. I think the question becomes, if you ever have to choose between making money and doing something good. it's very hard to imagine that you could possibly, there will always be money, for example, in tobacco and in alcohol. And to some extent, if you exclude investing in those, you make it cheaper for everyone else.
The one thing that seems to be working really well for ESG is as a marketing device, as a label, as it were. But at the same time, the more it's used for that, the more it can be cynical, and in fact, you can not be doing what you think you're doing. How do we separate out those who are just claiming it from those who are doing it?
Well, that is one of the reasons we've got the degree of skepticism and the degree of backlash at the moment. You've seen the head of DWS, very big fund manager, fall on his sword after there was a whistleblower pointing out that they were greenwashing, i.e. that they really weren't trying anything like as hard to ensure that the companies they were investing in were doing green things as they said they did. The SEC is looking into rules on naming conventions and so on. This happens for the rest of the industry. There may be certain much more difficult barriers you need to cross before you can say this is ESG or environmental or ethical. So that is a big concern. I mean, one of the things that I find truly ridiculous actually about the ESG concept is if you look at, there are different indexing groups producing different ESG ratings, and it's a very big, difficult exercise, and they charge money for it if you want to use it based on an index. But the correlation between the different ratings groups when it comes particularly to governance is almost literally zero. Like if one company gets a perfect score from MSCI, that tells you nothing about how good a score it will get from S&P and so on.
Well, and one of the things I don't understand is if we do have the government be the environmental police, the ESG police, the way Larry Fink is calling for, I think I can understand how they could police reporting on carbon.
Yes.
Okay, that seems quantifiable.
Yes.
Do we want the government deciding what's socially responsible or what is good in terms of government? So, by the way, wouldn't it change from government to government depending whether it's to the right or to the left?
Yes, it would. I do think that's a very good point. I think environmental, it's a very complicated issue about how we manage the transition. If you try to put too much investing into clean energy before it's ready, you get the issues of that Europe has had in particular of suddenly becoming that much more reliant on natural gas. But yes, the task of quantifying is much more straightforward when it comes to the E. The S and the G may, I think, they are very much more in the eye of the beholder, and it's much harder to justify saying that any particular rating agency or any passive funds group can be in charge of them.
One last one here. I've enjoyed covering business and economics in news because I've always said money doesn't know right from left. You just make money or don't make money. Is this potentially a way for politics to creep its way into investment decisions? Because there's a certain woke element, to use that overused word, involved in ESG, which is not to say it's not very serious, but at the same time, there is an element of that.
There's a very big element of it, and what most worries me is that the basic technology now exists for targeting something you don't like and punishing it in some way via the markets. You have an index and then you exclude certain things from it on certain criteria. And two can play at that game. One classic example which has bipartisan support, but I think it could be the start of a dangerous principle, is there's a government thrift pension plan which is under bipartisan pressure. Marco Rubio leading it, Maggie Hassan, Democrat from New Hampshire, saying that they mustn't invest in China because it's a national security threat. And that can easily become habit forming. You see Japan pension funds started investing much more outside Japan to help weaken the yen when there was a desire for them to do that, and so on. This could become, now that we understand how to do ESG investing, it could become weaponized and could become quite a dangerous element in the unpicking of globalization.
John, this has been so terribly helpful. Thank you. That's John Authers. He's the senior markets editor at Bloomberg. Coming up, we wrap up the week with special contributor Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We're joined once again by our very special contributor, Larry Summers of Harvard. So, Larry, CPI numbers this week. I must say, going back to March of last year, you said that they've made the biggest fiscal blunder in 40 years, and inflation would be the result. Boy, we're having it. But were even you surprised by the level of these CPI numbers?
I think today's numbers surprised most observers. I'm not sure it should have. It's pretty clear that peak inflation theory, like transitory inflation theory, is kind of wrong. And it's wrong. You see it in the overall numbers, and you also see it in the pervasiveness of the components. Almost everything is up significantly, and my guess is that there's some major components that are actually going to accelerate in the months ahead. I think the shelter component is going to be rising at 8% a year by the end of this year. If you look at all the private sector indices like Zillow, they're going up much faster than that. If you look at the inflation numbers, medical care is still looking low. I don't know what that number means. Every time I talk to anybody in medical care, there's a desperate nursing shortage. There's a huge backlog of elective procedures. So I think that number's going to be going up. So I think we've built ourselves a stagflationary kind of situation. And as I've been saying for months now, I think a soft landing's not going to be easy.
What about the core versus headline?
The core is below the headline, but the core this month, which was supposed to be one of the good months, was at an annual rate of close to 7.5%. So that's nowhere near an acceptable level. And I think the Fed's forecast from March saying that inflation would be coming down to the 2s by the end of the year was frankly delusional when issued, and looks even more ridiculous today.
So let's talk about the Fed for a minute. President Biden has made it clear he thinks this job is first and foremost one for the Fed. Most would agree with him. What should the Fed do in response to these kinds of numbers? Let me be very direct with you. Emergency rate hike, should that be on the table?
I think an emergency rate hike a week before a meeting would look panicked and is an unwise strategy. I think the deliberation has been between 25 and 50 basis point moves a couple months from now. I think a more fruitful deliberation would be between 50 and 75 basis points. I don't think anybody thinks that we're going to get out of this without interest rates being significantly higher than they are right now, Fed funds rates. And I don't know what the advantage of delay in raising the Fed funds rate is. And I think given that monetary policy acts on the economy with a significant lag, there's some real disadvantages to delay. So I'd like to see the process be carried forward with a lot of energy and determination. The Fed is saying the right words, but I think they don't appreciate the extent to which, given the mistakes they made through last year and even into the early part of this year, I don't think they appreciate the extent to which those mistakes mean that they don't fundamentally have credibility.
So, Larry, picking up on that, what would indicate to you that the Fed does, if I can put it in the vernacular, get it? I mean, should there be changes in personnel? Should there be a difference in the overall approach to the Fed? Do we need to know what went wrong?
I'd like to see much more effort at understanding why their forecasts were so dramatically wrong and have been so repeatedly wrong. It's true, as they will be quick to point out, that often they have echoed the consensus of professional forecasters or whatever, but this is the fundamental responsibility of the Fed. I think the Furbus model, which is at the center of their academic process, their economic forecasting process, that's the FRB US model, is not really fit for purpose in terms of inflation. I think they need a different approach. I think that successful organizations have substantial ranges of viewpoint that are debated and synthesized. What you have to be struck by whenever you look at the dot plot is how much homogeneity there is across all the people at the Fed who are thinking about the economic outlook. I think you do have to ask, why do these mistakes keep being made?
Larry, in addition to the CPI numbers this week, we also got University of Michigan consumer sentiment numbers which were at a record low. The lowest it's been, 50.8 was the index. The lowest it's been since they started doing this back in 1978, which is basically when I was at law school, frankly. So what's the significance of that potentially? And I want to tie it back, if I can, to stagflation, because my understanding is that economists tell us one of the issues of stagflation is when the expectations are there will be continued inflation, and the driver primarily of that low UMich consumer sentiment was the expectation of inflation.
Look, it can't be good. I'm not sure how well you can compare those numbers over time. It's sort of a surlier time, and people are more disgruntled in general. You know, sentiment may be maybe the lowest it's ever been, but that's not true, certainly, of spending behavior. But look, it's a clear negative indicator, and it goes with what I've been saying, which is I think everybody's got to be anticipating that we're going to not have inflation come down extremely rapidly, and we're going to enter into a period of substantially more sluggishness. That's what stagflation is, poor growth and problematic inflation performance. And I fear that that's what's ahead of us, given the supply shocks we have suffered, and given that we experienced those supply shocks after we had very substantially overheated the economy because of the policy errors of 2021.
Larry, let's finish this week with a couple of rapid fire, one of which is Lina Khan, the chair of the FTC. We've talked before about what you described as hipster antitrust. We saw her interviewed by the Financial Times this week. She went after private equity very explicitly, and a lot of the criticisms were not so much about the economics as the conditions of workers in companies that are bought by private equity. What do you make of what she's saying?
That's not her job. Her job is competition. Competition between companies and making sure that it's robust. It's not to pass judgment on who the owners of the companies are. I was very sorry to see that. Frankly, a lot of her writings were quite problematic, but many had assured us that her deeds were going to be reasonable and provide the new rejuvenation that antitrust represented. That interview seemed to me to be back to academic populism of a quite unfortunate sort.
And finally, Larry, you have a long and very distinguished curriculum vitae. And included in that, of course, is president of Harvard. Now we see Harvard is going to be looking for a new president. By the way, joining Columbia and MIT and NYU, there are a lot of big institutions of higher learning looking for presidents. It was never an easy job. How much harder is it today than it was, say, 20 years ago?
I think it's probably harder given all that has to be navigated, all the various social revolutions we're having. But I think it's much more important, because I think there's never been a moment when ideas and bringing forth new leaders has been more important. And I think the centerpiece, seeking truth through open debate, committed to the most excellent scholars pursuing the best ideas. I think all of that is, frankly, under challenge on our college campuses in a way that it has not been in many years. And so I hope the new generation of presidents is going to rise to that challenge of truth-seeking and excellence at a moment when there's a lot of turbulence and a lot of forces at play.
Larry, thank you so very much for being with us once again. That is Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, Boris Johnson has a slip between the cup and the lip. Will it cost him his job? That's next on Wall Street Week on Bloomberg. Finally, one more thought. What a difference a party makes. Prime Minister Boris Johnson survived a no-confidence vote of his own party this week by a surprisingly narrow margin, but a win nonetheless.
I can announce that the Parliamentary Party does have confidence.
UK Prime Minister Boris Johnson has won the Conservative Party vote on his leadership, as many had anticipated.
It all grows out of parties held at number 10 Downing Street during lockdown, when no one was supposed to be gathering at all, much less to imbibe adult beverages in large quantities, and much less at the Prime Minister's own residence. Partygate is far from the first time that prominent political leaders have been caught out for their social activities. Think of Wilbur Mills, the powerful head of the House Ways and Means Committee, getting pulled over in the middle of the night, only to have an Argentine stripper jump out of his car and plunge into the tidal basin.
Now, I've been embarrassed beyond words about this experience. I apologize again tonight for what happened.
Or married presidential candidate from the 1980s, Gary Hart, caught on a yacht traveling to Bimini, photographed with a young blonde on his lap.
I just didn't use good judgment, that's all. I used very poor judgment.
But maybe times have changed since the staid era of the 70s and the 80s. We're now living in a time when a presidential candidate bragged he could commit a crime in broad daylight and not lose support.
They say, I have the most loyal people. Did you ever see that? Where I could stand in the middle of Fifth Avenue and shoot somebody and I wouldn't lose any voters, okay? It's like incredible.
And although President Trump didn't exactly do that, he certainly committed some peccadillos that didn't stop him from becoming president.
Yes, the Trump Organization was responsible for initiating the idea of paying off Stormy Daniels and Karen McDougal to keep them quiet.
So while pundits are quick to point out that Boris Johnson has less support than that enjoyed by Theresa May when she was forced out of her job,
I will shortly leave the job that it has been the honour of my life to hold.
He may just be right that in this day and age, he can just move forward.
We have a conclusion to something that's been dragging on for far too long, and we have the ability now to unite, deliver, and get on with the people's priorities, and that is what we're going to do.
Maybe, but he may just want to think twice before he throws another party at number 10 Downing Street. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.